Okay, so you've given us some really interesting stuff to dig into this time.
Yeah, definitely a whole lot about investing and how to think about the markets.
It's all centered around this book by David Dreman, Contrarian Investment Strategies, The Next Generation.
And we're going to go deep on it, right? Try to pull out what's really important.
Yeah. The core ideas, like what Dreman is saying about why some common approaches to investing might not work as well as people think.
The dangers of relying too much on what these so-called experts are saying.
And then, of course, his whole introduction to this contrarian way of investing,
Plus, we have a bunch of tables and figures from the book so we can really see the data behind his arguments.
which is key. The goal here is to give you some clear, actionable stuff you can actually use without overwhelming you with too much information.
Yet make it digestible.
Exactly. So just to set the scene a little bit, the excerpts we're working with are from the late 1990s, specifically the introduction to Dreman's book. Think back to that time the market was booming. Everyone was super optimistic. It's kind of the perfect backdrop for starting to question some of the traditional thinking about investing, isn't it?
Absolutely. It creates this really interesting tension. You've got this prevailing belief that growth stocks are the way to go. That's where the
Yeah.
big money is going to be made. And then you have Draymond coming in and saying, hold on a minute, take a closer look at this. Maybe things aren't as simple as they seem.
Right, right. And that's what makes revisiting his work today so valuable, I think, because no matter what the market is doing right now, it's always good to challenge your assumptions and think critically about how you're approaching investing.
I totally agree. So why don't we jump right into part one of the book, which
Yeah.
is titled Why Current Methods Don't Always Work. And right away in chapter one, Draymond uses this really vivid casino analogy. Can you walk us through that and explain why it's such a powerful image?
Oh, yeah, the casino. It's so striking. Basically, he's saying imagine the market as a casino. And there's this room, the red room, where everyone is crowding in. This represents the high growth, popular stocks. Everyone wants a piece of the action. There's this buzz and excitement. But Drummond suggests that, just like in a crowded casino, the odds might not be in your favor.
Yeah. All that attention and excitement can inflate prices, making those high growth stocks riskier than they might appear at first glance. The more people pile into a trade, the less likely it is to be truly profitable for everyone.
Right. And then he contrasts that with what he calls the green room. The green room is much less crowded. This
Yeah.
is where you find the less glamorous stocks, the ones that maybe aren't getting as much attention. But it doesn't mean they don't have value.
Exactly. They might be overlooked or undervalued simply because they aren't the hot new thing.
It makes you wonder, if all the smart money is chasing those high growth stocks in the red room, maybe there are better opportunities hiding in plain sight in the green room.
That's the contrarian mindset starting to take shape. And it's not just an analogy. Draymond backs this up with data, right? Figure one of the book shows how professionally managed mutual funds actually performed compared to the S&P 500 between 1987 and 1997. What do you see when you look at that data?
Well, it surprised me to see that in a lot of those fund categories, the average returns were lower than the S&P 500. Like take aggressive growth funds, equity income funds, general growth funds. Over 3, 5, even 10 years, they didn't do as well on average. It made me think, wait, you're telling me that even professional fund managers with all their resources often don't beat the market?
It really challenges that assumption that paying for professional management will automatically get you better returns, doesn't it?
For sure. It made me question if just picking actively managed funds is really the best way to invest. And then Draymond introduces these new conquistadors. They're basically these big academic theories like the efficient market hypothesis or EMH.
Ah, the EMH, a real game changer in investment theory. What's the basic idea behind it?
Okay, so the EMH says that stock prices already reflect all the information that's out there, meaning any new information that comes out gets priced in immediately, so it's impossible to consistently profit from it.
Right. It suggests that trying to beat the market by picking individual stocks is, well, it's like trying to outsmart the collective wisdom of everyone who's already participating in the market.
And that's what Dreman calls the Titanic clash, this battle between traditional fundamental analysis, where you try to find undervalued stocks by digging deep into company financials, and this new belief that the market is already so efficient that you can't really find those undervalued stocks.
Yes, it's a clash of investing philosophies. The traditional analysts believe you can gain an edge by doing your research, understanding a company better than the average investor. But the EMH argues that the market as a whole already does that job incredibly well.
So you're kind of fighting an uphill battle if you're trying to outsmart the market. And it wasn't just fundamental analysis that got called into question, right? Dreman also talks about skepticism towards technical analysis, even astrology.
Oh, yeah. He's not a big fan of technical analysis at this point, looking at past price movements to try and predict the future.
He's suggesting that there's not enough evidence to say that it actually works consistently.
Right. It's all about finding a reliable way to predict market movements, and Dreman seems pretty doubtful about that. So that's part one, setting the stage by questioning a lot of the common ways people think about investing. But then part two gets even more provocative with this title, The Expert Way to Lose Your Savings. What's going on there?
Oh, that title, I know. It really grabs your attention, doesn't it? It's like, whoa, wait, the experts, the people we're supposed to trust. And that's exactly what Draymond is getting at. This section is all about the potential dangers of just blindly following what the experts say.
Because even experts get it wrong, right? In fact, he starts off chapter 4, Dangerous Forecasts, with some pretty wild examples from history, like military predictions that were completely off base, or literary predictions that missed the mark entirely.
Yeah, it's almost funny how wrong some of those predictions were. But his point is that even the smartest people in all kinds of fields, not just finance, make huge errors when they try to forecast the future.
And if those experts can get it so wrong, should we really expect financial experts to be any different?
It really makes you think twice about just taking their word for it. Especially because, so many investment decisions are based on these financial forecasts, like analysts' earnings estimates.
Which, as Dreman shows, are often way off.
Way off is an understatement. In Figure 5.1 and Table 5.1, he looks at the average error in analysts' earnings forecasts over a long period, something like 25 years. And the numbers are pretty shocking, right?
They are. Remember the average error.
Something like 40 to 50%. That's crazy. It's not just being off by a little, it's like missing the target entirely. And when you think about it, even a small miscalculation in a company's earnings can have a huge impact on its stock price.
It highlights the huge amount of uncertainty involved in financial forecasting. And then Chapter 6 goes into earnings surprises and how the market reacts when companies announce earnings that are different from what analysts were expecting. Figures 6.1a, 6.1b, 6.1c, 6.3a, and 6.5 show how these surprises play out in the real world. What patterns do you notice?
Well, one thing that really jumps out is that the market doesn't react the same way to positive and negative surprises.
Right. There's this asymmetry.
Yeah, it's interesting. A positive surprise where a company does better than expected might give the stock price a temporary boost, but it doesn't necessarily lead to long-term outperformance. But when a company misses earnings estimates, especially if it had a high price-to-earnings ratio to begin with,
Oof, that's when things can get ugly.
yeah, the market really punishes those companies. Their stock prices can take a big hit and stay down for a while. And it makes sense if you think about it. If investors were already expecting a lot of growth from that company and then it doesn't deliver.
It can shake their confidence pretty badly.
And then Draymond talks about some of the psychological factors that can influence analysts' forecasts, right? Like overconfidence.
He even brings up a study about how people tend to underestimate the costs of projects. That same kind of optimism bias can show up in financial forecasting.
So it's not just about bad data or faulty models. There's this human element too. We're naturally inclined to be a bit more optimistic, even when the facts might suggest otherwise.
Which is why it can be dangerous to base all your investment decisions on what the experts are predicting.
And this leads us nicely into part 3 of the book, where Dreman finally introduces the world of contrarian investing. This is where he starts to lay out his alternative approach.
Okay, so we've seen the limitations of traditional methods, the potential pitfalls of relying too much on expert forecasts. So what does it actually mean to be a contrarian investor?
Well, it's about going against the crowd. It's about looking for opportunities where others aren't looking or are even running away from.
It means being willing to invest in stocks that are out of favor, that maybe seem a little boring or even a little scary to most people.
But the key is, those unpopular stocks might actually be undervalued.
Precisely. They might have solid fundamentals, but for whatever reason, the market isn't giving them the love they deserve.
And that's where the contrarian sees an opportunity. But is there any real evidence to suggest that this actually works? Does going against the grain really lead to better returns?
Well, Dreman presents a lot of evidence throughout the book. Starting in Chapter 7, he talks about this research by Francis Nicholson, summarized in Figure 7.1 and Table 7.1. Nicholson studied stock market performance over a long period, like almost 30 years, and found that historically, stocks with low price-to-earnings ratios, or PE ratios, outperform stocks with high PE ratios.
So you're getting more bang for your buck, so to speak, with those low PE stocks.
Exactly. You're paying less for each dollar of earnings. And then he brings up Benjamin Graham, who's like the godfather of value investing.
Oh yeah, Graham is a legend. His research, shown in Table 7.2, basically backs up what Nicholson found, that low PE stocks tend to do better in the long run.
So you've got multiple studies over different time periods, all pointing in the same direction. And then Dreman comes up with this great phrase, more nasty, ugly little facts.
Yeah, I love that phrase. What's he getting at there?
He's highlighting how the market's obsession with growth stocks, those shiny, exciting companies, can cause it to completely overlook companies that are fundamentally sound, but maybe aren't growing as fast.
Right, those nasty, ugly companies might have consistent profits, strong balance sheets, good management teams, but they just aren't sexy enough for the market to care.
And that's exactly what a contrarian investor is looking for. They're willing to look past the hype and see the value that others are missing.
And Drummond doesn't just rely on other people's research. He did a ton of his own analysis too, right? Looking at different valuation metrics like price to earnings, price to cash flow, price to book value, even dividend yield.
Yes, he tested all these different measures of value, and the results, shown in Tables 7.3, 7.4, and 7.5, and Figures 7.2, 7.3, 7.4, and 7.5, show a pretty clear pattern. These value investing strategies, buying stocks that appear to be cheap based on their fundamentals, have outperformed the market on average over the long term.
And he uses some really interesting company examples in Chapter 8, like Galen Healthcare, Columbia HCA Healthcare, and Eli Lilly. Their stories are in Figures 8.5 and 8-6. What's the takeaway from those examples?
They show how companies that were once unpopular or facing some challenges can turn things around and deliver significant gains to investors who had the foresight to buy them when they were out of favor. These stocks were considered undervalued even though they had the potential to recover and grow.
So it's not just about finding statistically cheap stocks. It's about understanding the underlying business and seeing the potential that others are missing. And there's another benefit to contrarian investing that Dreman points out: lower turnover and potentially lower capital gains taxes. Why is that?
It's because contrarian investing tends to be a long-term strategy. You're not constantly buying and selling, chasing the latest hot stock. You're buying companies you believe in and holding them for the long haul, waiting for the market to recognize their true value.
And as Table 8.2 illustrates, that patient approach can lead to lower transaction costs and potentially lower taxes in the long run.
Because you're not triggering those capital gains taxes as often if you're not selling frequently.
Yeah.
So to kind of wrap things up here, it seems like David Dreman makes a pretty compelling case for contrarian investing.
Definitely. His work really challenges some of the traditional assumptions about how we should approach the markets.
And it highlights the limitations of simply following the crowd or listening to every prediction the experts make.
Because, as we've seen, those methods don't always lead to the best outcomes. Contrarian investing, on the other hand, has a strong track record of outperforming the market over time.
And it encourages you to think independently, to question what everyone else is doing, and to look for opportunities where others aren't looking.
So our final thought for you today is this: how might considering a contrarian approach change the way you think about investing? How might it help you find those hidden gems that everyone else is overlooking? We encourage you to dive deeper into the principles of value investing and really explore the ideas that David Dreman presents in his book. It might just change the way you see the market, and it might just lead you to some really great investments. Thanks for joining us.